Good morning, everyone. How are we doing? October 9th, 2021. We have seen explosive growth in the community in a way that I've never seen before. The tweet that went out last night, I woke up this morning and it was up to 250,000 views, which quite frankly is shocking. Very exciting, but definitely shocking. And so today I just want to take the opportunity to once again kind of walk through some of the basic mechanics. And I also want to talk about DAO, because there's a lot to be discussed. There's a lot of questions about the mechanics. And I think it's always good amidst a growing community, a rapidly growing community, to take the time to slow down and re-educate the community. That is to say, your protocol is your mechanics. And so if your community understands the mechanics, if they understand how the fundamental protocol works, then your community understands the innovation. They understand the significance of what's being built. And so I firmly believe that the people that create like innovations in the blockchain space, if you're one of the core contributors, I think a large percentage of your time has to be devoted to educating. So I'm gonna hop in here, share my screen, and we'll get started. Good morning, Austin. Good to see you in here. So today's topic is going to be the DAO. But before we jump into the economics of the DAO and how we're allowed to offer a limited epoch-based no slippage entry from like an economics feasibility standpoint, I want to run through Shade Protocol and the vision briefly. So Shade Protocol is an array of connected privacy-preserving DeFi applications built on Secret Network. And the first of many applications is Silk. Silk is what I would consider a fourth generation stablecoin. It's featuring privacy by default, collateral backing via treasury and staking, as well as algorithmic open market stability mechanisms that most of us are familiar with. So Shade Protocol is auditable. The programmable privacy of Secret Network is an amazing feature. It's the reason we're on the tech stack. Everyday users have the opportunity to decrypt their own transactions and be auditable and compliant. The Ethereums of the world and the Bitcoin are completely and utterly transparent. And there's very distinct problems emerging in the DeFi space because of total transparency. I'll list two. The first is copying of on-chain strategies. Whales, there are APIs existing to track institutional investors. And in the world of trading strategies, it is unbelievably difficult to have the entire world be able to know exactly how you're generating alpha. And this is essentially an unavoidable problem. I mean, there's attempts at layer 2 privacy solutions. These are honeypots. These are closely watched. And starting with privacy by default, as opposed to starting with transparency and trying to force privacy, the privacy by default is by far the better approach. And so we have these totally transparent chains. There's many problems with them. We have billion-dollar MEV front-running problems, and just wait until cross-chain front-running begins. That's an even more difficult problem to solve. The more connected all these transparent blockchains get, the more apparent the MEV problem is going to become. Even though we're seeing, brilliant innovation on the anti-front-running perspective. On Secret Network, with Shade Protocol, front running is it's not relevant. It's just not relevant. And so compared to these totally transparent chains, you have the Moneros of the world that are completely and utterly private, that regulators aren't going to touch with a 10-foot pole. It's a black box. But Secret Network is able to straddle this line. So all the products that are built into Shade Protocol have a path to compliance and auditability, which is very, very important. Shade Protocol is decentralized, it's algorithmic, and there's really 5 features I think that differentiates Silk and the peg and the mechanics of the stablecoin that differentiate it from other protocols, other stablecoins out there. Because we wanted to add privacy to a stablecoin, but we also saw that there was a bigger opportunity to also innovate within the DeFi space. There was an opportunity to create a set of DeFi applications with privacy fundamentally incorporated. And so Shade Protocol and the Silk Peg is treasury backed, staking backed, it's private, and there's also an extremely active DAO attached to Shade Protocol. When we look at the Cosmos SDK, when we look at the existing quote-unquote DAOs attached to layer 1s, they weren't designed to play a hyperactive role in the ecosystem. For the most part, it's a pool of money that people can go to and request funds from. We have like Terra Luna is a good example. There's $1 billion on that treasury. And if you actually look at the code itself, it just like mints it out for the user, right? It's not like funds actively sitting there. Like it has the opportunity, I believe, and someone can correct me if I'm wrong on this, but it just, the treasury concept wasn't designed to be this super aggressive DAO. But when you make an application layer product, you suddenly have way more flexibility. And because Shade Protocol and Silk inherits the security model, Secret Network, we suddenly have the ability to have a DAO attached to this system that has a massive opportunity to play an active role. So the Shade DAO, it's going to be staking layer 1 tokens. It's going to be liquidity providing at some point. And there's also going to be regular occurring rewards for Shade stakers. And so we're really looking at lots of different products out there, and we're taking, the best components of a lot of them. And DAOs as an emerging trend, it's kind of ironic because they've been around since 2017, 2018, but we're starting to see a lot of innovation and realization of what DAOs are capable of. And Shade Protocol will be directly part of that trend. Silk is also an index currency. I think this is probably one of the boldest visions we have for Silk. It is the decision to have Silk not be tied directly to any sovereign currency. We call it global yield derivation. And in 2021, being directly pegged to the US dollar, or being directly pegged to the euro or the yen, these are all wonderful things. And for consumers, for end users, that makes perfectly good sense. But we're building Silk for a decade down the road, for 3 decades down the road, when the crypto economy has emerged so much that the concept of a global stablecoin that is not tied to any given single sovereign currency risk makes the most sense. And so I don't know if the world is ready for this type of index currency. But in my mind, to quote Bezos, actually, it's easier to invent the future than to predict it. So that's what we're attempting to do with Silk. We're attempting to, envision a future global economy where a privacy-preserving global stablecoin with extremely stable, open market stabilization mechanisms that's, indexed globally is something that end consumers want more than just sovereign currency. So how does this work? These are the core mechanics of Shade Protocol. We have an expanded graph from this, but I'll start here. something that we call entry minting, and that's actually what I'm going to be talking about today, the economics of the DAO, specifically the DAO-based entry 1 and 2 on the graph, because we've had a lot of questions about this. Essentially, what a user is allowed to do is they'll be able to convert. Actually, I should explain these on here quick. Okay, so we have Secret. This is the native staking token of Secret Network, the wrapped privacy version. We have Silk, which is the stablecoin. We have Shade, which is the governance, treasury, and utility token of Shade protocol. And then we have Synthesis, which is the DAO. So entry minting, 1 on the graph, a user is allowed to send $1 worth of Secret to the treasury, and in return, they are given 1 Silk. And by the way, we're using dollars on this graph because it's easiest to translate. Note that it still will be globally pegged at some point, but for the sake of simplicity, we have it in the form of dollars on here. A user is also allowed to send $1 worth of Secret to the DAO and receive $1 worth of Shade. So you have this interesting system where the user is really directly collateralizing what they're minting out. And we can do this because it's a carefully capped entry minting mechanism. So when a user converts from 100 Secret, let's say each Secret is worth $1, they're able to trade out $100 worth of Secret and get 100 Silk or $100 worth of Shade. And this is a no slippage entry into the system, and it grows the treasury. So 2 beautiful ideas, right? We're growing the treasury. We're giving this no slippage entry in a space where there's lots of problems with liquidity and no slippage. But you have to cap this. You have to cap entry minting because there are some very distinct attack vectors if you just allowed people to have unfettered minting access into Silk and Shade from the entry minting. So it's a limited feature. This was many months ago. This wasn't an unfettered. Originally, it was unfettered access into the system, but after testing and modeling, we realized this had to be hard capped. Had to be hard capped. And I believe on I think on the Secret Code podcast, you guys should go check them out. I had walked through the attack vectors that exists by not having hard cap on entry minting. So tentatively, from what I know from the core contributors, I think 7.5% is the annual limitation of the DAO-based entry. That's as much as we'll allow to enter into the system over the course of a year, and it's epoch-based. It's like an epoch-based reset. So you'll have everybody queued up in a line trying to take advantage of this no slippage entry. If you don't get in on the no slippage entry, you can just go to the secondary market and buy it. You'll have to experience some slippage there, right? Not everyone gets to take advantage of this limited DAO-based entry feature, but it's super cool. No slippage, limited feature. You grow Synthesis, you grow the treasury. Now, let's shift over to 3 and 4 on the graph. 3 and 4 on the graph is conversion minting. Seigniorage is probably the term most people are familiar with. And the way conversion minting works is whenever Silk is trading off its peg, let's say it's trading at $1.02, users have the opportunity to convert $1 worth of Shade for 1 Silk that the market is valuing at $1.02. And that 2-cent gap is what is arbitraged. That's what people execute trades on. And by expanding the supply of Silk and burning Shade, classical supply and demand mechanics, we're shifting the supply curve to the right. This is what pushes the price back down to $1.03 in the bottom right-hand corner. The inverse scenario is also true. If Silk's trading below $1, there has to be a way to push the peg back to $1. And this is done by reducing the supply of Shade. And what users are allowed to do with the contracts is they burn 1 Silk for $1 worth of Shade. And that 1 Silk, the market's valuing at less than $1. And this is the part that I think a lot of algorithmic stablecoins wouldn't necessarily mention to you with this type of model. But essentially, we're drawing on the market capitalization of Shade, and we're pushing it into Silk, pushing it back to $1. So your greatest defense in a contractionary event is it's really 2 things. It's the market capitalization of your stabilization token, in this case Shade, and it's also the amount of capital willing to arb the peg. So you have to have a very active arbitrage community, and you have to have a very solid market capitalization in relation to the amount of the stablecoin outstanding. Now, with Shade Protocol, we add in 2 additional stabilization mechanisms. We say we are going to have Shade stakers and the Treasury also participate in stabilizing the system. And those 2 help by stabilizing the system in that collateral grows into an arbitrage bot that also helps arb the open market. So if Shade staking has, hundreds of millions of dollars one day, and if the Treasury has billions of dollars one day, suddenly everyone can look at the peg and be like, wow, there's $1.3 billion arbing the peg, and that's separate from institutional and retail investors. So it's just adding an extra layer of stabilization to the system that is super, super helpful. And that arbitrage is also profitable. So for Shade stakers, for the Treasury, it's going to be passively earning rewards over time. And that inspiration for this type of integration directly into the protocol came from Woetzel and their arbitrage product. Huge shout out to that team. Super, super cool team. And the idea is like you take that idea and integrate it directly into the mechanics of the stablecoin and the governance and the staking. It's such a beautiful product idea. And we saw that as like let's take inspiration from that. Let's take inspiration from that type of thought process. So Sky is the name of the arbitrage bot. Like I said, the Treasury, stakers, collateral is deposited into it, and it goes ahead and performs execution. B and C, you'll see in the bottom right-hand corner. That's 3 and 4 on the graph. The bot's just looking at the dexes on Secret Network, spotting discrepancies, and just directly interacts with the minting contracts, and is able to realize a net gain over time. And Synthesis, the DAO, once again, I'm going to be walking through the economics of the DAO-based entry shortly. Just wanted to run through the mechanics. It's a really big vision for this because we don't just have to have Secret that's allowed to do this DAO-based entry. With IBC, we're going to be able to accept Atom. We could accept Luna. We can accept Secret ETH, Shade, whatever have you. Well, actually, no, Shade wouldn't be accepted. I take that back. The focus is largely going to be on significant layer 1 tokens. And the idea is that the Treasury, as it receives this DAO-based entry, this no slippage entry, it's going to turn around and stake this collateral. So assuming we have 4, 5, 6, 7, 8, 9, 10 million Secret, enter into the DAO, enter into Silk and Shade. The Treasury will turn around and stake that 10 million Secret. And this creates a really beautiful scenario where the application layer is helping secure the underlying protocol. That's conceptually kind of a beautiful idea, right? Because you inherit the security model of Secret Network, and then the application itself, because it's locking up supply, is benefiting. There's big plans for Synthesis. Synthesis is really the crux, because as we add more and more applications into the Shade Protocol ecosystem, everything will feed back to Synthesis. It'll feed back to the Treasury. And so there's kind of different philosophies with what you can focus on. You can have apps that are really focused on burning your underlying governance token. You can have, applications that are really about incentivizing a certain action. And I think we have 3 simple rules for any Shade protocol application that gets added. You have to increase the scarcity of Shade, or you have to build demand for Silk, or you have to grow the Treasury. And another distinct design decision is every time a new application is added to Shade Protocol, there will not be a unique governance token for each one. I think one of the biggest criticisms I have for the blockchain application ecosystem in general is it seems like we're designing applications to generate value for tokens as opposed to generating value for the end user experience. And naturally, there has to be a token involved in all of this, in all these applications to incentivize the builders, to incentivize capital to partake in the systems. But I think we'll look back in a couple years and it will be very obvious that every application having its own token was not optimal or sustainable for end user experience. So tokens are necessary. It's incentivization. It's economics. But is it necessary for every application to have its own token? That was a bit of a side rant. Thank you for bearing with me on that one. Back to synthesis. It'll be staking layer 1 tokens. It can be buying staking derivatives from other protocols. So synthesis could be helping secure Atom one day. You name the protocol. It could help secure Juno. Once there's staking derivatives, synthesis will have the opportunity, because anything a person can do, a DAO can do. And once you realize that's the case, it's mind-blowing. Absolutely mind-blowing, these DAOs that people are going to be spinning up. So I realize my camera's blocking the bottom right-hand corner, so you can just see it's that graph right there. Synthesis as well, we have really big plans on the liquidity providing side of synthesis. There is a massive problem in the world of DEXs where you can ask a simple question. What happens when the distribution of liquidity providing rewards comes to an end? I think it's a cataclysmic event in some ways. You can ask that question for a lot of DEXs on Ethereum. And it's one of those problems that has been kicked down the road, right? Because as long as there's rewards, capital will come. It's like a rent-seeking model. So there needs to be a way to have sustainable LP rewards for liquidity providers that's sustainable over time. And this is some research I'm doing in the background, and I think the path to that is based off of utility-based rewards for liquidity providers, and also treasury participation in the liquidity providing setup in a sustainable way. And I think sustainable models are going to be what have staying power in blockchains. There's so much noise out there, but the protocols that will win, and we will look back and say, wow, that was blatantly obvious they were going to win, is the ones that we're building for the multi-decade economic vision. Not the ones that were, hey, this distribution model runs out in 5, 6, 7, 8 years. You have to have a sustainability approach when you're building economic models. You just have to. Or you're just setting a timer. You're putting a timer to all these things. So synthesis has visions for sustainability. And I think that's very, very important to the core team and everyone that's taken part in the design of the overall protocol. So this is the end architecture. Actually, oh boy, my camera. We're gonna make myself real small for a moment. This architecture is the sum of many months of work. And this is probably the best visualization to date of this. You have, secret. You have banned protocol Oracle that's querying prices for secret, such that we can figure out the rate of minting for Silk and Shade. That's 1 and 2. You have conversion minting 3 and 4. People will be allowed to stake their Shade. And the beauty of being on the application layer is that layer 1 protocols, when they stake, they do so because they have to help, they have to incentivize securing the underlying layer 1 protocol. But shade staking, because we inherit the security model, we don't have to worry about incentivizing the underlying protocol. The only thing shade staking has to worry about is helping maintain the peg. That is the risk that stakers take with shade. Just like in the traditional layer 1, the risk that is being taken is the getting slashed. You could get slashed in the process of helping secure the underlying protocol. In a similar sense, shade stakers interacting with the Sky arbitrage bot, there's some level of risk of stabilizing the underlying protocol. And as you can see here on the graph, we have synthesis. Both staking and synthesis feed into a component of synthesis that partake in the arbitrage bot. We have the staking of secret attached to here. And I think one of the most exciting things we have is synthetics. we realized that this over-collateralized model of MakerDAO, UMA, synthetics on Ethereum, and Mirror, that we don't necessarily have to do that. And no one's done this before, by the way. This same model of Silk and Shade that keeps an asset at $1 can also be applied to a moving asset. So let's say we're looking at Tesla. You can have a peg that as Tesla's price goes up, the conversion minting contract's peg is also shifting. So you have a unique stabilizer token for every synthetic. You follow this identical Silk Shade model, but instead you have the synthetic and the stabilizer token. And the end result of this synthetics market is there's going to be way less pricing premiums. These leveraged based, because that's what they are. They're not calling it leverage based, but when you put up collateral and you mint something out, you're in a leveraged position. And why would you ever put yourself in a leveraged position, mint something out, and liquidity provide? You're holding all this risk of having to manage the LP because you're technically in a short position. You're also managing the debt of minting out that synthetic. You're also managing the fact that you have a liquidation price in there somewhere, right? So why would you ever do that when you can instead go on the open market, buy the synthetic asset, and liquidity provide it? You never have to worry about the risk of that leveraged position. And that was kind of the realization is I think we can do synthetics better. It's a really bold vision of having unique stabilizer tokens for every synthetic. And the end result is we don't have to have people in leveraged positions to expand the token supply of the synthetic. It's purely based off of supply and demand and utility and usage of those synthetics. So synthetic assets will be coming shortly after Silk and Shade. It's the next product on the roadmap. And to be honest, it's an open experiment. No one's done this model for synthetics. But we actually already have the whip on our GitHub for synthetics and stabilizers. So because it's essentially a recursive model from Silk and Shade, it's not going to be that hard to implement it and test with it. And every time we launch a new synthetic, there's a new stabilizer token. And guess who's going to be receiving stabilizer tokens? Shade stakers. Every time a new synthetic token launches, there has to be a stabilizer token attached to it. And that stabilizer token first gets started by being sent to shade stakers. So we're very, very excited to see what that looks like. You'll also see on the graph that Silk is the entry into synthetic. So just like you have this DAO-based entry into Silk and Shade, there's also a DAO-based entry into synthesis to have that no slippage entry into synthetics and stabilizers. So this is another reason why you'd want to own Silk. So you have this opportunity to enter into synthetics and stabilizers with the same feature that you can enter into with Silk and Shade. So the treasury is going to be gaining Silk, which is helpful for maintaining the peg. It's also helpful because it's a stable coin, and it's always good to have stable assets on a treasury. Lots of opportunities for the DAO to use that. So shade staking, we'll have traditional staking rewards, treasury rewards, arbitrage rewards. You'll also have stabilizer airdrops, and it will be a 21-day locking period. So now that we've kind of walked through, we've talked about this DAO-based entry, kind of this, you hand off $1 worth of collateral to the treasury, and you're able to, with no slippage, mint out the respective asset. Treasury grows. But how are we allowed to do this? And we are doing the, capped DAO-based entry. But I want to talk about this simple question. How are we economically allowed to offer a limited no slippage entry? So I'll exit out here and pull up Jamboard. And I apologize in advance for this. I'm no artist, so this is about to be some real bad artwork. Give me a moment here. And I'll check out chat after this. I'm just focused on for all the people that will be watching this replay. This is really for you, the focus. So we have synthesis right here. Actually, we're just keeping, we'll call it synthesis. I was gonna say we could just title it the DAO. Synthesis. Also would not recommend drawing with a mouse. Very, very inconvenient, right? So we got synthesis, and then we have, we have the user right here. We have silk. Okay. And we have shade. And then we have the conversion minting between these two. Right here. So let's think about this for a moment. So the user, they deposit collateral into this system. Let's say it's $1 worth of secret, okay? And then in return, they are given 1 silk, right? So synthesis, contract-wise, silk tells it, all right, just received $1 worth of secret. We're gonna mint out 1 silk. So right away, this presents an interesting problem, right? That we have to reconcile in our head how this works economically. So if we think of supply and demand, this curve right here, So when the user deposits the $1 of secret, the treasury, the value increases right here, right? Okay, so this value, the total value increases, okay? But when we minted out the 1 silk from this DAO-based entry, the supply curve shifts to the right for silk, right? So, silk, let's say we're in a very limited supply world. When we offer up this no slippage entry, we've minted out 1 silk and we've expanded the supply. So the price of silk drops. Now, this is a really weird paradigm to think about, right? Because when supply expands, price drops, but the user gave up $1 worth of collateral to be able to mint this silk. So why is it that the price and the supply gets diluted? How do we reconcile that when there's value sitting on the treasury that is supposedly 1-to-1 backed with that allowable no slippage entry? And the answer is you can reconcile this supply increase with the collateral. And the way you would do this, and this is like an economical justification of what could be done, is the treasury synthesis, if it wanted to resolve this this dilution that's allowed on entry, the DAO-based entry when it grows, is the treasury would go to a DEX, right? And it would spend $1 worth of secret, which it received from the user, and it would buy silk. Okay. I guess this box is going to nowhere. Well, we'll say that this meant buying silk, right? Now, think about this. Silk supply expands, but then the treasury with that $1 of 1-to-1 backing can go to a DEX, buy $1 worth of secret. Think about what that does to supply and demand. Essentially, the demand curve is going to end up shifting right. So the idea is like this demand curve shifts, or actually shifts. Oh, my bad. This line right here, this demand curve ends up shifting back to the same exact starting point we were at before. That's how we're allowed to reconcile the DAO-based entry. So to really simplify it, there's 2 forces at play. You have the supply increase right here. The supply increase. This supply increase is a downward force. Okay. And the treasury, if it chose to use that $1 worth of collateral that it gathered to buy silk is the upward pressure. And so this is how you can reconcile. This is a net neutral force. That's why we can say, all right, Treasury receives collateral, we mint out silk, because if the Treasury chose to take this set of steps to reconcile, it would stabilize the system. But here's the crux of it. This is the kind of the beautiful realization, is the user is given a no slippage entry. Guess what has to experience slippage in return? The Treasury. The Treasury, when it goes to the secondary market, if it wanted to try to, resolve the supply increase, the Treasury is what experiences the slippage. So that's how this whole system works. There's 100% value capture on the way in. It goes to the Treasury. The supply expands. The way that would be reconciled is the Treasury goes to the secondary market. It experiences slippage, and that increase in demand from trading the dollar worth of secret for silk is what ultimately is a net stabilizer. And I think that's just like a beautiful concept, that the DAO is the one that's suffering the slippage costs in order to give the user the opportunity to have the no slippage entry. Now, I want to make it very clear that the Treasury doesn't go on the open market every time someone deposits, value into it to suddenly to resolve this disparity, right? We are saying we're going to, expand the supply of silk or expand the supply of shade. But it's just like the economical concept of, because one-to-one value was given up, the Treasury could resolve that if it wanted to. And this is the economic explanation of how that would resolve it, essentially. So hopefully that offers up some clarity to the DAO-based entry, kind of how those economics work and how they can be justified. And this is also why it has to be a limited feature on an annual basis, because there's some pretty whack attack vectors if it was just like, oh, I can pass in millions of dollars worth of value with no slippage. It's super easy to break the system in that scenario. You have a whale or a hedge fund drive down price on the open market. They mass mint in, mass dilute the system, mass sell off. They have a massive hedged position, and the whole system breaks. So that is why there is a hard cap on what's allowed into the system on an annual basis, because you have to be predicting the mass attack vectors from people with essentially an unlimited amount of capital, right? I suppose that's not entirely true. You can never say unlimited capital because it's representative of scarce resources. But anyways, I'm going to stop presenting now. I'm going to open up the YouTube chat in a moment here. I'm sure there's some questions. Always are. Okay, where are we at? Way too many tabs opened up. I need a bot to just exit out of my tabs after I leave my keyboard. It would be unbelievably convenient. Here we go. Test. What? Chat disconnected? Strange. What happened here? Okay, I switched chats. All right. Here we are. So that's a good question. How do we the daily shade entry minted is less than daily shade burned? So when you start net, we essentially have projections for this in terms of monthly allowable shade that can be minted on an epoch basis, and essentially demand for silk and the amount of shade required to burn into to expand the supply of silk, with the demand for silk on the other end of it, far outstrips kind of the limited DAO-based entry into the system. 7.5% is the target number at this point. Can you lose your shade by staking it? So the answer is no. The arbot is essentially programmed to only execute the safest possible trade to bring it back to peg. You're essentially shifting back and forth between silk and shade in this arbot. And so you could eventually have a scenario where everything shifted over to one side and the peg still ends up, running down. At that point, it's up to the open market to restabilize the system. So it's no different than like any institutional or retail investor trying to bring it back to peg. You can't just you have to have enough capital to keep reversing the effect, and that's why it's like the beauty of game theory based resolving any peg disparities is because you have the whole collective market arbitraging it. So it's not that you would lose money, it's that the arbitrage bot would essentially stop being able to realize profits until you saw kind of like a market reversal. I think that would be the best way to describe it. It'd have to transition from a contractionary event back to an expansionary event before it could essentially reverse its steps back. Make this abomination you're drawing an NFT. Let's see here. Yeah, the synthetics game is actually insane. The synthetics game is going to be so fun to see how it plays out. So we have some questions here. One, is the protocol going to be live? So if you go to shadeprotocol.io, we have a roadmap on there. And I would say that roadmap is the best representation of the pacing for the protocol and how it's coming along. This project's 5.5 months in. There's quite a few developers working on this. And I'm optimistic. I'm very optimistic. We already have, there's code audits already being established. Those relationships are being established. So we'll be entering into the audit stage, hopefully very, very soon. So that's always encouraging. We want to do it right, though. I think one of the biggest mistakes you can make in this space is rushing a protocol, especially when it has this large of a vision. So while we have targets on the roadmap, it is going to be up to all the developers taking their hands off the keyboard, looking everyone in the eyes, looking each other in the eyes and saying, yep, we're ready. Let's do it. So we get this question about minimum staking for Luna. And to my knowledge so far, there's no minimum. It's going to be, equations still being established, but as a general principle, the more you stake, the more you earn. So if you have a super, super, super small amount of Luna being staked, more than likely, you'll be earning a very small amount of shade. What can you do to directly help the project? That's an awesome question. So there is UI, UX incentivized testing that is in the works. So stay tuned in the Telegram for that, because we're going to have the opportunity for people to earn some shade by participating in feedback. So we would love to have you. We want the front end experience to be guided by users. So many times developers, they make an application, they make a front end, and they don't actually user test it. They get to the end, users are like, we don't like this. And developers are like, I don't understand. And the users are like, you never talk to us. So that's one of the guiding principles as we design the front end experience for Silk Shade Synthetics, is that users should be guiding the end. They should be guiding the end product and their experience with it. So be sure to be part of the testing, and being active in Telegram is huge. Being active in the Twitter community is huge. At the end of the day, if you want to be a significant contributor, if you really want to help take Shade Protocol to the next level, it is a decentralized movement. So feel free to reach out to anyone on the team if you genuinely want to, put some time and energy into it and you get the vision. Well, the door is always open for significant contributors. So anyways, guys, it's 10:45. It was 45 minutes of walking through some of Shade Protocol. I hope you guys enjoyed this episode of talking about the DAO and its potential and the economics. And I hope you guys have a wonderful day. Happy building.